G'day there. Welcome to the Closing Bell. I'm recording this on the 28th of July, the Friday. And we had some news overnight about Japan possibly looking at shifting on their yield curve control. And now that is pretty big news. S&P 500 got hit pretty hard from where it was. And markets have been rallying very strongly, as we all know, over this last little period. So it is big news if we do see a shift in policy from Japan. So I do want to take you through that in detail in a minute. But first off, next Monday, I'm running a quick presentation for people about really what's going on in the big picture in the markets. I've pretty much done an analysis over the last 50 years of how markets are behaving around those major peaks, and wanted to outline for you why I think that there is a bit of a shift, a bit of a changing of the guard coming up. We're coming up to 2 years since the major peak was made in our market, in the ASX, back in August 2021. And you'll see that often it's not a bad time to be actually starting to accumulate stocks around that time. So I'll be doing that presentation for you. I'd really love you to join me if you could. You'll know that over the last sort of few months, if you've been watching this, I've been giving you a couple of trades every now and again to give you a sense of how I go about things. Last week, I sent out one on NXL, and that stock's up 35% in the last 5 days. You could have got on that on the Monday after I told you about it last weekend for $1.10, and that's currently trading up around $1.48 and has been up to $1.55 this morning. So, a 35% move in 1 week. Hopefully that's made a few of you sit up and take notice. I gave you Megaport 3 months ago at $5.77. That's up at the mid-10s, hit $11 this morning. That's up 80% in 3 months. So, hopefully you're getting a sense over time about how I go about things. I don't just trade for the sake of it. I've been sitting on my hands for a long time in my trading service, especially Retirement Trader, which is really a major service for me where I take a very more conservative approach, but I'm still trading. I'm trading using my methodology that I've been showing you. I'm taking part profits along the way, trying to turn things into free call options, really, trying to make sure that we either break even or make money. That's what I really want to achieve in all of the positions I go into as soon as possible. And I'm using that trading model that I'm showing you, the way markets sort of move back to mean reversion over and over again, whether something's trending or ranging. That's the sort of thing I take advantage of, trying to get into a very strong position quickly with people. And so that's really what this closing bell is all about, is to give you a sense. I give you a lot of information, maybe not all of it. I'm not going to give away all of my trade secrets for free, that's for sure. But you do learn a lot if you do become a member of one of my services. And look, on Monday, I really do want to outline for you how I go about things. If you've been impressed with what you've seen, I'd really love you to join me for that. There should be a link showing up now that you can click on to really get a reminder for the presentation happening on Monday. And look, if it's after Monday, the link should take you straight through to the video to be able to watch my presentation on why I think the markets are close to shifting from this terrible period we've been in to something a bit more constructive. And it's really important that you are acting in these windows when they turn up, rather than just being bearish because everyone else is bearish. Sometimes you've got to do the opposite of what the crowd is doing, and that's really what I want to outline for you in these presentations. So hopefully you'll join me then. It's not often that I do get the chance to bring new people on board to what I'm doing, and really the closing bell is showcasing my work for you. And I'm hoping that you've been impressed so far, and hopefully a few of you did get onto NXL last week and you're sitting on 35% gain in 1 week. which is not bad. So let's move on to checking out what Japan's up to. So this is a chart of the Japanese 10-year bond yield going back quite a few years. And you'll know they've really been the one that got the ball rolling on keeping interest rates incredibly low for a long time since they had their big crash. You'll remember they kept rates very low. Their debt, government debt, is just immense. That's what they've used to help keep themselves afloat. And you can see here that rates going to 2016, going to zero. That's the zero bound right there for their 10-year. Remember, 10-year bond yields, zero. And they went negative there for a while, back in 2016-17 and then 2019 to 2020. And you can see that it has actually picked up with interest rates flying higher around the world. There is that pressure on the Japanese yields, but they've kept them incredibly low. So you can see here that Japanese bond yields are stuck at 0.5%, and they haven't been allowing them to go higher. But remember, US bond yields up around 4.5%, the 10 years, and the 2 years up around 5.5%. So Japan having their rates down at 0.5% is pretty crazy low. And they're going to be importing a lot of inflation, obviously weakening yen, also affecting them. I think their inflation really is starting to kick back to the upside, and they're going to have to respond. So are they going to loosen up again and see these rates fly higher? Now, that is a distinct possibility. That is what the news was last night, of the potential of something like that going on soon. And you'll see that the rates really kicked higher just last night, back to that level, the 0.5% level on the 10 years. Now, this could be a bearish outcome for stocks, and you really got to be aware of it if we see rates kicking higher. Now, Japan, because they have their rates so low, they're investing offshore, in Australia, all around emerging markets, etc., etc. Do you know of Mrs. Watanabe, which is that, or whatever it is, they say the retail people, investing offshore in US bonds because they can get a yield. So there's a lot of money flowing out of Japan going into America buying bonds. Well, and just government is one of the biggest holders of US bonds in the world, or is the biggest holder. So if these Japanese rates really do kick higher, there could be a lot of money flooding home, potentially going back into these bonds, because it's a lot lower risk to be, if they can get a much higher yield on these 10 years, it might be worth their while. So that could see a flood of money coming out of markets and being repatriated to Japan, which could kneecap the rally we've seen just recently. So it is a bit of a short-term risk. So I just wanted to make sure that you're sort of aware that it is pretty big news if something like that does happen, because they have been just holding rates low for so long, and Japan has been such a big investor, such a big exporter of capital for a very long time. So that definitely is something to be wary of, and I want to show you the S&P 500 quickly. So here is the S&P 500 monthly chart. We know this one well, 2009 down there. What a huge, strong rally for so long. The trends turned down there. We've been following this along. Been a really difficult one to work out this last little period, as the short-term trend was up. But you had the weakness from the long-term trend pointing down. So we have had a bit of a shift in circumstance. I mean, it's the first time, for a while since last year that the long-term trend has actually kicked higher. So that's just something to note there. For me, that doesn't mean it's definitely now all on and bullish, but it is something to definitely be aware of. And really the last line of remaining bearish on this thing is what I've been sort of describing for you over a long period, is analyzing these waves and how the market responds to them. So if we go up and look at the rally since 2020, I've shown you this before, but it's a very important point about why the market could be in for a bit of a short-term correction before possibly taking off again. But we've got that huge wave to the upside. We've got the correction over the last year, hitting that midpoint, and then we've had the rally. And you'll remember I was telling you if prices did break out above that sort of 30, 40 to 50, I think it was, area, that was threatening the downtrend that we've seen in the correction. So we did see that, and we've had a nice strong rally in this last little period. But a lot of that was short covering, as I've showed you before, with the leveraged funds, had a huge short position in the S&P 500. That has been whittled away on this rally over the last couple of months. And if I just go in and really look up close at this correction, I just want to point out that where prices are right now is just at the top of that sell zone of the correction. So this period, this little area here, is the spot where people are now, the people who are getting short through the correction, so through this period here over the last year, they are covering their shorts on this rally, and people are getting bullish. So also fund managers were selling out and getting ready for bad times, so they were underweight stocks. A lot of them will be sort of forced buyers as the market picks up and starts trending. So really you're at the point where most people are starting to get pretty bullish, or at least the bears are capitulating. And it is that spot that my model does pick out as the area where you can all of a sudden see the music stop, and prices can then revisit that point of control, the midpoint of that correction to the downside. So if we do see the selling erupt here, that could see prices head back down to around 4,200 in that S&P, just in the short term. That's a 400-point move, a bit less than 10%. So that could be a good size correction. But that doesn't mean it's not then going to find support and, take off to the upside. And now that we're getting nearly 2 years into this correction, look, that is definitely a possibility with that long-term trend turning up. So, big picture, things are looking brighter, but just wanted to point out that right now is a little bit of a dangerous spot where we could see some short-term selling pressure coming out of the woodwork, and that would be based on this sell zone of that correction that we've seen over the last year or two. So that's just to give you a sense of where these, important points are and how I, look for opportunities within them. You'll see down here's your buy zone of that wave. You've seen the correction, then rallied to the point of control, you can see there. And then the selling pressure went down into that buy zone and kept seeing buying pressure. So it's a similar thing on this side, where often it can look like it's away, but then the selling pressure comes back in. And even if it's going to just, bounce on there for a bit before taking off, it's just the way markets behave, wrong-footing people over and over again. So with this Japan news, it'll be interesting to see what comes out of that. It can be quite bearish in the short term. Be aware of that if the yield curve moves in Japan, it could see money coming out of emerging markets and probably Australia too. So it could be short-term weakness ahead on that. But very big picture, thinking of that 2 years after the correction, I really want to be able to chat about that for you, about the opportunities that come up, all of these stocks that have been bashed over the last few years. I gave you Megaport, gave you NXL last week. You've seen the huge moves they've had to the upside. So some pretty big opportunities are starting to brew. So you can click on the link below there to sign up to listen to the presentation I'm giving on Monday, or see the video itself. So yeah, hopefully you can join me. That'd be great. All right, that's enough for this week. I'll come back with more next week.